Yeah.
Hey,
No.
Speaking of trying to make sense of what's going on, we're trying to make sense of the AI trade and how companies are funding their AI investments, because in the last few weeks, there have been some observers who argue that the important company to look at is Oracle. Sure, shares of Oracle are up 20% so far this year, but they're down close to 40% since that all-time high reached back in September. And then there are the credit default swaps. The cost of protecting Oracle's debt against default reached a fresh multi-year high on Monday amid investor scrutiny of the debt spree to finance AI investments. We got Robert Schiffman with us. He's Bloomberg Intelligence senior tech credit analyst. He joins us here in the Bloomberg Interactive Brokers studio. Okay, so I'm going to go over some numbers here, but then I'm going to ask you a really basic question about this. So the price of 5-year credit default swaps on the company's debt rose to the highest since October of 2022. It amounts to around $119,000 for every $10 million of principal protected. So those are the numbers. For people who don't know, why do we care so much about the price of credit default swaps, and how can they give us some insight into the health of a company?
Well, this must actually be the top of the market. There has to be a bubble because you've got the tech credit guy sitting in the room, even though tech credit spreads are near their all-time tights.
We have brought in some people from the GFC also.
Obviously, some panic.
All right, there you have it. He called it.
I'm going to answer on Oracle, but let me start off just quickly by saying it's okay. Don't panic.
Yeah.
The markets are holding up reasonably well. There is a little bit of weakness, and there are some yellow flags out there, and there is some company-specific information that's concerning. That being said, this whole AI trade, it's not a 1 month, 2 month, 3 year trade. This is a 10-year trade. And right now, we're in a building phase, spending a lot of money without a lot of revenues coming in. So it takes time. I can't disprove a negative. I can't disprove that money's not going to come into Oracle or Amazon or Alphabet or Meta, but I think it is. Now, that being said, why is something like Oracle CDS concerning people? Well, it's because single name CDS, particularly for investment grade names, generally don't trade. They do trade in the triple B universe. Oracle has been a name that hasn't traded, and then the reason why is that there hasn't been a reason to hedge in the past.
Yeah.
All of a sudden, there's a reason to hedge. Oracle issued $18 billion of public bonds. On top of that, they're in the process of syndicating $38 billion of private credit. What I think is really driving this move. And what is that? Why was CDS originally created? It was for banks to hedge their loans. It became a trading vehicle for a long time, and when we hear CDS nowadays, we think about the financial crisis. We think there's a name that's wider, we're blowing up. AAAs are defaulting. And I just think we couldn't be that far from the truth. There's a combination of fundamental, but I think more technical reasons why this is happening. So you have banks that have tremendous amounts of exposure to data centers, not just Oracle, but a lot of these data centers that are non-investment grade, like CoreWeave, a lot of other data center builds that they don't have the ability to properly hedge because there's not active CDS. So how do you hedge your positions? Well, what you do is you hedge via the higher rated credits, where you can potentially buy CDS that cost next to nothing. 20, 30, 50 basis points, even 120 basis points is not very much, because that's how you can hedge your data center risk. And you can do it really cheaply. Then on top of that, what happens is hedge funds join in. You have a momentum trade here that goes on where somebody sees, whoa, Bloomberg wrote a report on Oracle CDS. We haven't seen CDS in the headlines in 10 years. What's going on? First thing for a hedge fund manager to do is to say, I'm going to buy CDS. I'll get the answers later.
Right.
And on the back of that, what ends up happening is, where do you find the natural sellers of CDS? Where do you find somebody that says, oh, you know what? Oracle at 60 over, 70 over, I'll sell you protection, because what's my upside to doing that? And I think what's happened now is that you've got fundamentals that are not great in the near term. Oracle's free cash flow is going to be massively negative for the next few years. They're going to have to fund that with even more debt, which is going to have to be hedged both in the public and private markets. So you get this cycle of people coming to try to buy CDS. There's not a lot of sellers. It pushes it wider. That being said, Oracle is sort of standing a little bit alone. You really need to go down the curve to more liquid names like CoreWeave, where you're seeing big moves like this. When you look at the names like what I call the Mount Rushmore of credits, you know, the Microsofts, Apples, Amazons, Alphabets, We're seeing a little bit of spread widening. You're seeing people starting to try to buy some protection, particularly from Meta. And why on Meta? It's not that Meta has underperformed from a credit, from both a credit and an equity perspective, but it's because Meta did a $27 billion private data center deal. And that's the way that the banks are able to hedge that. Now, there are some large asset managers that bought that deal, but there's still a lot of banks that are involved with that are hedging their position. So it's a little bit of fundamentals and a little bit of technicals.
So don't be worried.
Well, as bond people,
I mean, what would you have to see to say, okay, we've got some problems here?
So the reason why I'm a little bit less worried, first of all, the big names that I mentioned, we barely see any sort of spread movement. And quite frankly, you mentioned Oracle stock is still up 20%. All these other names, other than Meta, are up significantly this year as well. So it's also from a starting point, right?
But it's still down 40. Oracle's down 40% from, Carol and I were sitting on the beach in September at an event.
Yeah.
And Oracle was just surging higher.
Yeah.
This was like
listen, there's more equity
after the company reported earnings that day. Yeah.
Research doesn't get to go to the beach, but that being said, we see that, but you got to remember, we're coming off of all-time highs. So equity valuations, listen, stocks could be down 50%. I still don't think that would mean there'd be any fundamental change in what expectations are. So I just think when you look at credit markets again, credit spreads for the investment grade tech sector year to date are 15 wider. We're about 5 wider on the entire high grade sector. We've primarily underperformed because of a couple names like Oracle, and there's been a lot of bond issuance that have pushed spreads a little wider because there's more bonds that are trading. But there is no panic in our market. There's a worry that a name like Oracle, as they continue to fund, could in theory go to non-investment grade. What would happen? They have $100+ billion of public debt outstanding.
Right.
It's non-economic. You can't run a high yield business like that. So one is, I think the rating agencies...
Just got about 20, 25 seconds here.
The rating agencies are going to give them room. I think they're going to give them time. Even though there's negative outlooks at S&P and Moody's, I do not see Oracle going to junk. I also think there's a huge backing in the capital markets, as well as the U.S. government. If Oracle were to need capital, and if Larry Ellison needed some sort of favors, it would happen.
I know, but that doesn't necessarily make me comfortable.
It should make you comfortable.
All right. Robert Schiffman, this was so good. Thank you so much. Bloomberg Intelligence Senior Technology Credit Analyst. We'll be reaching out to him, I know, again.